Very good afternoon, everyone, and welcome to today's uLaw webinar. The topic for today's webinar is Disbursements Demystified. Today's webinar is accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. I repeat, it's 1 hour of professionalism credits. This session is being recorded, will be available to you as early as Monday next week, and you are able to view this on our YouTube channel, ulawpractice, at any convenient time of yours. At all times, please use the chat window to ask any questions that you may have, and both me and my staff would be more than happy to answer them. And if you're using the computer and if you are facing any audio quality issues, you also have the option of dialing in to the phone numbers provided. I'm just entering it as we speak. Fantastic. So let's jump right into the webinar. Like every other uLaw webinar, this webinar has this very specific agenda where we're going to talk about disbursements, a very key component of your day-to-day legal business management, understanding the options that you have as a legal practitioner and how best you could use the different financial vehicles to manage disbursements, including the use of trust accounts to pay for disbursements right out of your trust account, as an example, and some of the benefits of doing that, the steps involved in taking that vehicle as an option. We'll also look at certain examples of disbursements that you would pay predominantly from your general account. Right? There are a few rules to the game in terms of which types of expenses would you use for utilizing your trust account compared to your general account. We'll talk about that. And finally, we'll explore the expectations from the Law Society as it pertains to documenting and reporting on these disbursements. Okay? A very key, critical component of your compliance requirement is understanding how best to record and represent the disbursement information in the form of compliance documents. So that's going to be the quick agenda for today's webinar. And time permitting, I'm going to certainly utilize uLaw as an example, if you will, as a way to showcase how best to use a practice management, especially a legal accounting system, to manage your disbursements. So we'll start with like a basic definition of what is a disbursement. For those who've been running your business for a while, I'm sure this is pretty straightforward. I am, in a way, preaching to the choir. But for others who've just started off their journey, we have a lot of students who are just getting started. Hopefully this is a good start. Okay. So if you really look at a layman's definition of disbursement, it's really expenses that you as a legal office incur on behalf of your client. Okay. I'll go one step further and expand that, saying, are the expenses incurred by yourself or your legal firm on behalf of a client's matter? So it's very critical to appreciate that difference between client and client matter, because disbursements, like anything else, are very particular to the nature of that matter. There could be certain matters which have disbursements in them. There could be certain matters with no disbursements in them. It's very important to capture the details of these disbursements, the nature and the different financial institutions that you're using to pay for these disbursements by matter, so that it's easier for you to categorize and report. From an accounting perspective, of course, what it really means is that you have an in-date need to record the financial transactions around these expenses that you pay on behalf of your client, to ensure that your books are balanced, in quotes, which really means that you're able to appreciate, and at any given time acknowledge how, when, and why you spent for these expenses in accounting ledgers. Now, the Law Society's requirements are around ensuring that you're maintaining proper bookkeeping, and as part of your own business management, it's a very important component that can lead to your losses if not managed well, because this is a recoverable revenue at the end of the day, especially if you're paying out of general, and hence very critical from both the Law Society's perspective as well as from the perspective of your own business management to ensure that you're staying on top of your disbursements. Okay? So with all those definitions in place, let's move forward with further understanding the nuances of this game. Okay. So now we have a basic understanding of disbursements. These are expenses that are incurred while executing a file. So each and every matter and the area of practice may have its own unique set of types of disbursements that you're dealing with, right? You could have disbursements when it comes to real estate. You could have disbursements when it comes to small claims. There could be disbursements such as court fee, application fee. There could be postage, various different types of disbursements, legal travel, right? And it's important for you, both from the perspective of the Law Society, as well as from the perspective of you managing the accounting, to capture certain details of these disbursements. Okay, so recording key details or features of these disbursements are critical, so that it's easier for you to then report on. So what are these key components of disbursements that you need to record? First and foremost, of course, we start off with who is the client and what is the client's matter. So disbursements are specific to that. Then comes the component of date and when was this disbursement paid. Again, critical to the retainer letter agreement and the time period in which you have promised to deliver invoices, because these disbursements in many ways make their way into invoices. So very critical to capture when was this disbursement paid. Then capturing how was this paid. So did you use your trust account? Did you use your general account? If you have used your general account for payment, have you used your debit card, cash? Have you used your business credit card, personal credit card, right? Cash, check. There could be many different methods. And a simple understanding of the reason behind that expense so you can categorize them later. So application fee, court fee, etc., etc. As I mentioned before, top down, you certainly understand the client and the specific client matter for which these disbursements are being captured. Okay. Now, if you have a trust account, let's say, and if you are paying for these disbursements right out of your trust account, what that really means is you don't have to necessarily showcase this particular transaction and wait for a payment or take an action such as a trust transfer to earn that money back. When you're paying out of trust account, the money is simply taken out of the trust account. Maybe there's a retainer component that's available and the disbursement comes out of that retainer amount, making it very simple for everybody involved, both from a bookkeeping standpoint as well as for you to acknowledge how the money was transacted. Okay, so that's the first thing. You don't have to capture many different components that you otherwise have to capture when it comes to the general account if you paid so. So if you have paid out of your general account, then depending on the nature of the type of expense, you may need to capture and send a pre-bill so that you get approval for that. Maybe that's part of your retainer. You have to wait to recover that expense unless you have a retainer. in which case you still have to take an extra step of transferring the money over from trust to general. And in some cases, you may even have to decide if you've paid that expense with a profit or a loss margin as component of that. Okay? Because when you're using trust account, you typically don't use the profit or loss margin. It's basically paid on actuals. The court fee is $100, you're paying $100. That's pretty much it. If you're paying a third party and you're adding a certain surcharge to the actual expense that you paid for, then you're certainly using the general account. Okay. Okay. So just further expanding on what we just discussed, talking about whether you're using the trust account or the general account. Let's look at some of the examples. So I mentioned court fee, application fee, and these are some of the fees that are easier when paid out of the trust account because you're paid on actuals. What you've paid the court or what you've paid the Ministry of Finance is just passed along to your customer as an expense in that file. As I mentioned before, when you're paying the disbursements out of your trust account, you don't have to recover that expense. You don't have to invoice it, wait for a payment back from your customer, or invoice and do what's called as a trust transfer, pending trust transfer, right? And our point is, if you're not necessarily looking to make money off disbursements, and if it's not your money after all, then why not might as well use the trust account? And last, it reduces the amount of bookkeeping and the number of steps that you have to remember to take to recover that expense. Now, of course, a prerequisite for this is that there is money in trust specific to that file. What that really means is that there is a retainer component as part of this transaction. That becomes critical to draw from. You need retainer amounts where you can use this disbursements to pay out. So you can pay disbursements for client matter A from a trust account for client matter B. That becomes kind of tricky. So it's best advised that you have a retainer in place for each and every matter. And if you're using the trust account to pay for disbursements paid out of the amount that is pertaining to that particular client file. Okay? Now, talking about general and paying out of the general business credit card or owner's pocket, whatever it may be, this is not using the trust account. This is where you're paying for it in advance. So let's assume the second case where there is no retainer, or maybe there's a retainer and you figure that you're not going to be using the trust account, you want to use the general account. So that could be your business credit card, this could be your debit, your own cash. If you're a sole practitioner, sometimes you may use your own money to pay for things such as faxes or copies, print copies, right? In which case, not only do you have to recover from the client, you also have to pay yourself. So one is recovering from the client for your business. And if you use your own money, such as the owner's pocket, then you have another step, which is recovering that money from your own business to paying yourself. Now, in the case of general, of course, an added component would that be that of you recording any appropriate taxes that go along with it. Right? So did you pay for your HST? How much was the amount? Capturing it separately, because that becomes part of that ledger document that's so important while reporting all of the Law Society documents that you need to present. Okay? But just like as we spoke before, capturing the method of payment, capturing the matter and specific client, capturing when, how, and why, is even more critical when it comes to you paying out of your general account. Because reconciling your general account includes the disbursements, which, as I mentioned before, is a recoverable, or it's a recoverable expense, but in the form of a revenue, because you have to reflect it in an invoice to showcase to your client that here is how much I paid for you, and I'm including it in my invoice so that you recognize that this is now part of the overall fees and disbursements that I need to capture back from you. Okay. So we've discussed some of the key features that you would capture as part of disbursements. We've pretty much discussed the 2 different or 3 different angles through which you can recover or pay for these disbursements and recover. Now the question is, when do you recover these disbursements? At what cycle? I mean, can I just do it as and when it happens? Do I need to wait a certain period of time? So that's the big question. And the quick answer to all of that is it really follows the engagement or the retainer letter, depending on what you've agreed with your customer, right? Whether you've agreed to raising a disbursement as and when it happens, or generating it, accumulating it rather, and then generating one invoice at the end of the month, in the case of corporate clients, for example, or including it as part of quarterly invoice that you raise to the customers. There's could be many different examples. The most common example is you recovering it as soon as you've spent it. So as soon as you've spent a disbursement, including it in the invoice, reflecting it, and then making your money. That's the smart thing to do. And we've often seen that's the case when it comes to retainer agreements as well, or engagement letters. Okay. So before you raise that invoice, a few things to keep in mind. You're recording the expense information with the date, recording the amount you want to invoice with the appropriate taxes, and if there's any markup or markdown with the appropriate taxes part of it as well. And this is primarily for your general account. Once captured, you then utilize any form, whether it's manual or using a legal accounting system or any other type of accounting system, to include it as part of your invoices. If you are using the trust account, then it's paid right out of trust. You don't have to include it in the invoice. If it's paying out of general, then of course you would have to include it in your invoice. And then if you have a retainer involved, and if you're going to be transferring money from trust to general, you don't have to wait for your customer to pay you. But if there is no retainer involved to begin with, then you have to wait for your customer to make that payment. And that's a key risk that you need to be completely aware and prepared for when dealing with disbursements that are paid out of the general account. So that you are at the mercy beyond, I know that's a strong word, but you certainly are dependent on your customer's payment when it comes to, especially when you paid for it ahead of time. Okay. Last but not the least, after you've done all of the due diligence work, captured the revenue, captured the expenses, raised the invoice, recovered the money, then you need to reflect this in the form of a storytelling to your auditors in the form of ledgers and journals, as per the guidelines provided by the Law Society. Okay, that's critical. There's a certain format in which the storytelling is requested, and we'll talk about that in a brief moment. Now, the types of disbursements and what are some of the best candidates for you to use the trust account. And we'll keep this simple. I know there's many examples here. As I mentioned, this is being recorded, and you can always come to this particular time to review all of this. But in general, the rule of thumb is Any expense that you are paying on actuals and recovering on actuals are great candidates for trust, right? It could be recovery expense on actuals, could be billable. It could be expenses on actuals or consultancy on actuals. So as long as they're the exact amount, great candidates for trust. But if it's not the case, if let's say examples such as mileage, unit rate, or expenses that you're trying to recover with either a profit or a loss margin, then most certainly they will be candidates for you to pay using the general account. Sometimes what happens in the case of real estate, you might use a third-party system where you're capturing all of these expenses, but you still would need to bring them over into your accounting system so that you can reflect on it. And you can make that as part of that statement and recovery statement to make your money back. Okay. Sometimes certain matters can have many disbursements, and sometimes in matters, depending on the nature, scope of work, disbursements may be really what you get started off with. Even before you start to put billable time or fees, you're having to deal with disbursements. And we've seen that with many different matters. So you've captured the disbursements, you know what to capture when it comes to the details of these disbursements. You have a fair idea of whether to use the trust or the general account to pay for these disbursements. And now comes the last step, which is how do you now tell the story to the auditor or make that part of your compliance package that you need to deliver both for reconciliation as well as for ledger and journal generation? How do you make this part of that document which is readily available for you to share when being asked for? So we'll look at the top documents that the auditor is going to ask for or documents that are part of that compliance package. As you very well know, during audits or as well as the need on a monthly basis, you're going to be asked to present the reconciliation statement. Most often it is the trust reconciliation document that a lot of the legal firms focus on because it's very critical that you don't misappropriate the trust account because money is paid in trust from your client. But we certainly believe that if you have the right tool, the right discipline, then reconciling your general account has an equal advantage to trust for your own business needs, so that now you're confident about the P&L of your own business. But in doing that, you have ledgers and journals that are a key component of your compliance package. And there is something called as a disbursement ledger, both for your trust and general, that is reviewed. So there are specific ledgers and journals for disbursements. Each and every transaction that we discussed over that date range, not just for a specific client, but over a date range. So imagine you have 10 or 12 different clients with various different types of disbursement needs. All of that needs to be recorded in this disbursement ledger. And as I said, depending on whether you've used trust or general, you may have to showcase both. And a critical component of these ledgers, as you've seen before, is a running balance. Okay, specific to a date, the date at which you're generating that document. So we've looked at ledgers. So you have a trust ledger and the general ledger specific for disbursements. Now you have disbursement journals. This is a different type of a document, where typically you're being asked to maintain some added information, such as the method of payment, which is otherwise not necessarily asked in the ledger. If I would look at let me jump real quick to the previous examples. If you draw your attention to this ledger, you can clearly see that there is the date. So when was this particular, let's look at the general ledger here. Instead of the fees, Let's say this was a disbursement. You can see there's the date captured, particulars around what was the reason for it, the actual amount, if there's any taxes involved, total, and you can see the running balance on it. Okay. Likewise, if it's a trust ledger, you can see if any money was dispersed out of the trust account. In both of these examples, you don't see disbursement examples, but imagine that you had a 565 worth of disbursements being taken out, then that's exactly what you would consider. Whereas in the journal, you have the date when the transaction occurred, yes. Who did you receive it from as a critical data point, the amount, and most importantly, the method used. So how did you pay for that disbursement? Was it a check, draft, credit card, etc.? Now, one added item around general disbursements is the fact that any office expenses that you incur, right, to run your day-to-day business, we spoke that disbursements are, of course, expenses related to a client file, but you as a business, to run your business, to keep the lights on, may have your own office expenses. Now that finds its way, those transactions around payments made towards office expenses, non-file related, make their way into the general disbursements as well. So if you really look at your general disbursement, you would have a combination of expenses on behalf of the client, otherwise called disbursements, and you would have expenses on behalf of the office. That's critical to explore the use of this unified system, such as a legal accounting system, that it can accommodate capturing, recording, and reporting on both these different silos of data captures. One is client related, the other is office related. Okay, something for you to keep in mind. And an additional document that makes its way into the compliance package as part of that audit need is the fee book, as you already know. And what does disbursement have anything to do with a fee book? The reason why the disbursements make their way into the fee book is because, as I mentioned before, the fee book captures all of the invoices, because the fee book reflects what's reflected in an invoice that need to be recovered from the clients. And as I mentioned before, again, the disbursements are a means of a recoverable income. You paid for this ahead, but you still need to recover it from your client. And the way you do that is through that invoice unless paid through trust. And hence, the fee book will capture all of the transactions that are related to general disbursements. So if you really look at an example of the fee book, though there isn't a data item in it, you would notice that there is a column called as disbursements billed to capture the disbursements, if any, as part of that invoice. You can see there's an invoice 001 that has fees billed, but there's a column to capture any disbursements that may have made its way through it as well. Okay? Very critical for you to keep that in mind. So we looked at 2 ledgers, 2 journals, and the fee book. So at a minimum, 5 different documents. And in addition, if you're doing your general reconciliation and trust reconciliation, those are another added 2 documents. So you have around 7 different documents that relate to your disbursement and disbursement related transactions that are all times you keep in mind as you continue to work your way through your legal business, dispersing and paying for these expenses in advance on behalf of your client. Okay. So before I move into kind of a slide share and demonstrating this, I will recap pretty much everything we've discussed the last 20-25 minutes. Actually more than that, it's almost half an hour now. So one of the advantages, as I mentioned before, that we think highly of a legal accounting system, whatever system that may be, right? It's the ability for you to capture, as I mentioned before, the siloed data representation, both from client and non-client related financial transactions. So you have office expenses that have nothing to do with your client. You paying the rent for your legal office has nothing to do with your client. Paying for a court fee for client matter has nothing to do with your business or your office expense. These are two separate entities, but they still get together in a document such as a disbursement journal. Either you have data in two different siloed systems and have a mechanism, both paper or automated, to reflect all of these transactions in one single document. So you have to take the effort to combine transactions across 2 or 3 systems. Or the use of the right legal accounting system should allow you to capture the data pertaining to these silos in a single system. So that's one big advantage of using legal accounting software, because that it considers trust and general account and the financial transactions around it. Because at the end of the day, when it comes to disbursements, a very important prerequisite is your preparedness to capture the moment as and when it happens, capture the details as and when they happen. Okay, so if you have a single system that allows you to do it, then you're in a better shape because it reduces the amount of bookkeeping and the time that you spend in ledgering and docketing all of this work. And modern legal accounting system, knowing the compliance need, have the compliance built in. Most of them do. So finding the right system that gives you that compliance, ease of use, ease of capturing is very critical as you start the 2022. Okay? I'm going to take a quick pause at this particular time to see if you have any questions before I jump into an actual demonstration, and we'll take some examples. We have enough time today for me to be able to take you some examples within the uLaw system, which is a legal accounting system in its nature that allows you to generate. And the importance of the system is that the compliance is built right in, where you don't have to generate these documents yourself. They're just built right in for you to report on. All you have to do is capture the data as and when it happens. So let me take a quick pause and take any questions that you may have. That's correct. So when I talk about actuals, I mean disbursements which I've received. Yes, that too. But also what you've paid is what you're actually recovering from the client too. So it's not like you paid $300 and you're asking for $500, because then it would be hard for you to reconcile your trust account, because trust account is going to be one-on-one for you to really understand what was this for against. So if an application fee was $100 and you paid that to the Ministry of Finance, then you are directly asking for the $100, matching the actual 100 to 100. If you paid for it from the trust account, or if you paid for as 100, but let's say you're trying to recover something lower or higher, then trust is not advisable as a vehicle for recovering your disbursements. That's what I meant by that. Another question that we have right here is there a single system? Oh, sorry. How can I get a quick view of all outstanding invoices? How can I get a quick view of all outstanding invoices? We can look into that. So what's not an actual is a good example would be consultancy fees. So let's say you didn't plan for this, yeah? So let's say you had to go to court, but you were unable to go to court, okay? You have someone else going to court on your behalf. Now, you may have to pay that person $300. But maybe you can only disburse your client $100 towards that particular type of disbursement. What that really means is that now you're going to raise an disbursement with a loss margin because you, as a business, are taking the $200 hit because you are unable to go to the court. You still need to do it to execute the file. But that would be not on actual. The actual was you paying $300, but you're only disbursing $100 to your client. I know that's a vague example, but the closest that I could think of on the spot. So it's really what you're recovering from the client is exactly not what you paid for. And it could be also on a profit margin. Sometimes you may buy a software at a discounted price. And certain softwares, legal softwares, may actually need you to charge by the file. So you may have bought a discounted software, let's say for $500, but you may charge each and every client $200. So with a little profit margin, so your disbursement recovery is with a little profit margin built in which case too, you shouldn't be using a trust account, and that would be another example of not an actual. Hope that clarified. Okay. I'm now logging into my uLaw system, logged in as my fictitious legal practitioner, Roger Moore. Okay. So let's take a client. Let's work on a client. Create a new client. Okay, and I'm going to skip all the, let's say, source of contact, newspaper. Okay, so I started by creating a client. I'm going to create a file or a matter for Mr. Kingsley. Okay, go ahead and click on the matter. So I'm going to create a file. Okay, Kingsley Spores. Okay. So I'm going to start with the first example where there's, let's say, a retainer involved. So I'm going to add that retainer. So let's say you've taken $1,000 fees as an example with another $200 for disbursements. I'm just assuming that you've done the smart thing of taking that into consideration. You may not, that's okay. Not going to worry. So what you're capturing includes the key components of what needs to be captured from a disbursement standpoint. So you're capturing when the disbursement, or again, this is a retainer, but I'll get to it. But you can see throughout all the forms that we fill out for data capture, we're always capturing the when, how much, how, why, etc. So let's say this did go into my trust account, which is TD Canada Trust, and I will move forward with my next step. Well, let's say there was a disbursement that's called a court fee that became the first component of doing business with this particular matter. When you are disbursing, you have the option to pay from trust or pay from general. If you're paying from trust, you're capturing when this happened, the amount, the method, so how, a reference, so it's easier for you to reconcile at a later time, and what was the reason? Court fee, who would it go to? From where did this payment come out of? And of course, in uLaw, you can also print this as a check if you like. Okay. Now, what's critical for you to look at is if you look at the projected balance, you can see it went from $1,200 to $1,000. And you can see all the trust receipt also went down from 1,200 to 200. So if I were to run compliance around my trust ledger, so let's say I do this for the month of March. Okay, we captured the data. We were able to do all of that in a single, maybe less than 5 minutes. And you can see this is the only client for March that we have. And here's the trust ledger that clearly articulates each and every transaction that's entered and left the trust account, including the disbursements that was paid off using the trust account. So we received the 1,200, and there was a disbursement from the trust towards the court fee in the form of a bank draft that reduced that trust amount from 1,200 by 200 with the running balance of 1,000. Okay. Now, from a bookkeeping perspective, you don't have to worry about sending this as part of the invoice. You don't have to worry about waiting for your client to make the payment. You don't have to worry about even if it's one small step, doing your own trust transfer to earn this money back or to recover this money. Came to trust, left from trust, end of story. What could maybe be meaningful is sending them a statement of activity at the end of a certain date range or maybe at the time of closure. Again, because with no dockets, it doesn't make much of sense. But you could send them a settlement statement, which really talks about each and every transaction that has come in and out of trust and general. Okay, at the least. Now let's take the example. You do have a retainer involved. Okay, there's $1,000. A second example of a disbursement, which you're paying out of general, but you're able to recover from your trust. Okay. Okay, let's take that example. Add another disbursement. This time, instead of directly getting it out of trust, you're now paying from general. And just to make it simpler on the data entry, we give you some examples of the types of general that this is. Is this an actual? Are you going to be paying third party? Are you prepaying a disbursement? Right? That is the example of that software I was talking to you about. Or is this paying out of your cash account or any other means. So let's say, for example, you're paying actuals. I'm going to say court fee or application fee rather. It's $150. Tax exempt. So there's no taxes. Let's say for the court fee, government fees, yeah. Paid to who? So you can see Ministry of Attorney General. The method of payments, you have the date, the method, certified check, and you hit save. Okay. Now it doesn't end here. So unlike the trust account, if I were to do my general ledger, and let's say I'm doing this for the month of March again. Okay. Download that. You can see there's no ledger information. You still haven't financially transacted it. You've just recorded something that happened pertaining to this matter that you paid. But this would still be captured in a different document, which is your expense book or your general disbursement. Ideally should be. There you go. The general disbursement still captures that $150 expense was paid for towards this particular file, KN721452. Okay? It's not made its way into the ledger. That happens only when you recover, and hence let's do that next. As you can clearly see, there's an invoice pending. So you would generate that invoice first. So step 1 is capturing the general disbursement. Step 2 is invoicing, so that now you've written this on stone. You're sending this document to your client. Okay, so here's the 150, and this is the running bill. So clearly it shows that thank you for the 1200. Here's 200 taken out of my trust account towards the court fee. Here is the application fee for 100, no taxes. And hence, when I withdraw that basically from my trust account, my trust balance will be left with 850. One additional item that you can do here, just to make it easier on your client, is let's reprint that invoice. You can mark this as paid so that now you're indicating to your client and being very transparent in that communication correspondence, but there's no action to be taken from your client, but you're indicating that don't be surprised when you see the trust balance drop to 850. The reason for that is this, that I have just paid $150 worth of application fee, which I'm going to be withdrawing. But it's not done yet. So the third step, first is reporting and recording, or recording. Second step is invoicing. The third is to actually do that trust transfer. And it's called the pending trust transfer. So this is you moving that earned money of $150 that you've earned now. It's yours. You still have to take this step. So you choose that particular amount. But tell us to which account was this moved to, because that's critical, right? Because we want to know which account was that. So let's say this is moved into my general account, also on Mississauga Road. In Ontario, if you did an electronic fund transfer, it's always a fun thing. But with COVID, if you're not visiting the banks or anything like that, if you're doing all of this online, then you capture that as well. And you also download a Form 9A, which is a Law Society document that reflects that. Now you've done that final step of moving that eligible money from trust to general. And hence, when you go back to your trust ledger, and you can see the 150 being reflected first in the trust ledger automatically, reflecting the application fee worth of 150 was now dispersed or removed from your trust account. And here's the running balance. You first set 1,200, got reduced 1,000 because of the 200 trust disbursement. Then it further reduced to 850 because of the general disbursement, which has been moved using the pending trust transfer through the invoice 3399 that was raised. So we're all legally compliant. Let's go into the general ledger, which was previously empty. Now it's not. It clearly shows you that you had generated an invoice for a disbursement, 3399. It tells the story, so auditors are looking for a trail. You clearly see the money left the trust account, entered the general account. And then you did the trust transfer from trust to general. So first it was fees that were billed, and then that got paid because of the trust transfer, leaving the balance owed at 0. Now let's say for the same client, for a different matter, I'm going to use the third example. I'm going to create a new matter. I'll say action, new matter, and some state. So much for my spelling. And I'm just going to make this up. Okay. Wait for the matter to be created. Oh, there it is. Okay, I'm going to now, there's no retainer, there's no none of that, right? I'm going straight into a disbursement and paying it out of general. Now, say tax. I'll do the actuals. The reason I do actuals is because we can now use your settings to use the rate that you have decided for yourself or your firm. Okay, you want to add the tax. You can add another disbursement. So it's 50 cents. Maybe I did all of this from my office. And I'll also add the same application fee. Pre-tax, let's say tax exempt. Same general account. Now, if you paid for this or for the other expenses from your owner's pocket, then that also gets captured, as I said, as a way for you to remember, to recover, to pay yourself. So first, the recovery happens for your business, and then you pay yourself based on the amount. Okay, now you can see there's the invoice pending. There's no money in trust, right? So I'm not going to be able to pay myself. I'm going to have to generate the invoice. Send this invoice to the client. Okay, here are the three different disbursements paid out of general. There's nothing in trust, and there's, or I shouldn't have done paid. That's a bad mistake. Because basically, in this, as part of the settings, it gets copied over. Let's reprint. Okay, there it is. The amount due, $326. And here it's where you start to use certain added new tools and technologies to help your client help you recover this money faster. If you're waiting for them to pay you, if you include a payment gateway integration so that they can look at that invoice, not procrastinate, and ideally pay you right away, then you're really helping yourself. Yeah. So we integrate with, of course, Maris, LawPay, Global Payments, TD, quite a few partners that we work with. We'll be more than happy to help give you more information about that integration. Okay. Now you wait for your customer to pay, and let's say they've paid you through the credit card, then you report that payment. Paid the credit card. Here is a reference number that got deposited into my general account. Because there are multiple matters, I will apply the payment of $326. And you can see we auto balance the amount towards one that's more meaningful. That's another added advantage of the system. Give them a receipt, very important. Okay. Okay, you can give them a receipt. Now when I generate, and this will be my last document for the day, when I generate my ledger document, I'm going to do the general disbursement. Okay, I'll do this for the month of March. Here's the $150 that you paid. General ledger. you can clearly see there are two different matters. The first one being the more recent one, which is writing a will. You've got all of those disbursements well documented, and the fact that they already paid for it using a credit card, that's been documented as well. Okay, so we've got three distinct examples of how you record, invoice, and report on disbursements that become very critical as part of your business management. Last but not the least, if you look at your fee book, which is another added document which we spoke about, all those general disbursements that made its way into invoices are captured. You can see the 4 different disbursements that we have. Okay? So with that, I will open the floors for any questions that the audience may have. Again, reiterating that today's webinar has been accredited for 1 hour of professionalism CPD credits. It is being recorded, will be available to you as early as Monday next week around disbursements demystified, talking about how important the financial management of disbursements are to a legal office and some of the best practices of managing these disbursements, both using trust and general accounts. I'll open the floor for any questions, and thank you once again for tuning in. So there was a quick question around a document that lists all of the invoices. So under accounts, document generation other, there's a document called invoice list. And you can choose this on whatever date time period you want. I think this was one of the questions. This gives you a list of all of the invoices that were generated in this date range. So for the month of March, as you noticed, today we generated 2 different invoices. And here's the report. It clearly states that. Okay, so hopefully that answered that question. Awesome. Well, thank you so much for your time. Look forward to speaking with you in our next webinar. Take care.